Hi, it's Drew Tignanelli. This is our February 2021 update. Unbelievable. Things really fly. Anyway, what's
like
happening?
The market.
Yeah, market's going up, continuing to go up, setting all-time highs as we shoot this video again.
Yeah.
It's no surprise the Federal Reserve has been very accommodative and has no anticipation of pulling back on the throttle, and that, in our opinion, is the big issue. How are the banks doing, and what's the Federal Reserve doing? And both are doing quite well right now.
Yeah. Now, Mark, the expectations for the markets do seem to be high right now. I review a number of public publications from Goldman Sachs and some of the others. All have very good short-term outlooks, even though one of the things that's being looked at a lot right now is the fact that rates are starting to kick up just a little bit.
Yeah, which isn't unexpected because rates went down so much because of the the collapse of the economy, I guess you could call it, back in March and April. But as soon as business activity started to pick up, you'd expect rates to go back. I mean, gosh, pre-COVID, the bottom of the interest rate 10-year market was 1.4%, and they went all the way down to 0.4% after COVID. And so for them to go back to the pre-COVID interest rates would not be unlikely.
No. And as a result of that, I know you and Chris are looking at making Chris and Roger, all making some adjustments to our fixed income portfolios. But overall, another topic when we're talking about rates is the fact that we've seen a little bit of inflation.
There has been inflation. I mean, house prices are going up, and that's a component of inflation. I have a good friend that's a contractor, and he's saying that when he goes to buy material, he's just shocked at, he priced it in at one thing, and now he's going to buy it, and it's double the price. And he's like, it's eating into his profit because he had a fixed price contract. So, that's going to be an issue, and that's not the only area.
But a lot of that, I think we're looking at that as a short-term issue. I mean, we see a lot of supply and demand imbalances that have been affected by COVID, affected by supply chain. I think a lot of those building materials are supply chain affected. Supply chain affected.
If you're a manufacturing facility and you had 100 people working in your factory, and next thing you know, you're down to 50 people working in your factory, and it's bouncing up and down, you're just not able to.
Shipping got so restricted. We get a lot of stuff from other countries, and it hasn't always gotten to flow. I think a lot of consumers have gotten to see the inflation this time because one of the statistics I saw is that the price of groceries has risen more than it ever has, and certainly the biggest spike since 1974.
Again, everybody heard all the stories about the meat plants and so forth, and the vegetable farming and so forth. It's very difficult in a COVID-related social distancing to be able to get that stuff out without impact on your workforce and keeping them safe.
But as Chris was saying, we don't expect this to be a structural part of inflation.
That's the point, is that it seems to be totally, the pandemic and social distancing, keeping your workers safe, that's making the prices go up. So as that rescinds, as the situation becomes better, you probably will see a giant increase in all those supplies.
So while we see kind of the stock market hitting all-time highs, it's not all sunny skies for everybody. I think there's a lot of pressure right now on some of the popular big tech stocks.
But I wouldn't expect that pressure to stay there unless government comes in and does something to them in the sense of regulation, antitrust rules, whatever it is, that would potentially hurt them. But a lot of those tech companies out there, they're in the sweet spot. They're where you need to be, and they ain't gonna slow down.
Yeah. But what we have some long-term concern over is deficit spending, right?
That's probably our biggest worry. Is are the politicians of the belief that you can just borrow and spend any amount of money, and there's never ever going to be a circumstance to that borrowing? You would right now, and this has been a conversation I've heard since Ronald Reagan came into office. That was 1980. You
Right.
know, and he ramped the deficit up, and they laid into him. But our debt to GDP back then was about 30% debt to GDP. We're now at about 110% debt to GDP. And Japan, though, is at 250% debt to GDP.
Yeah, so I think now when we use long term and short term, I'm going to try to give some context to that, but obviously we don't know timing. In the short term, we're talking maybe 1 to 3 years max. Long term, we may be talking 5, 7, 10 years. Short term, we don't see that in that deficit spending having a huge market impact. Short term, it's a long term concern, wouldn't you say?
It could,
And
it probably will be long term. If it ever happens, it'll be long term. And who knows when it'll be. Our focus is foreign investors buying U.S. debt. Because when foreigners invest in your debt, they also have a currency concern. So if your currency starts to decline and you've got a lot of foreign investors owning your debt, they ain't going to be happy at all.
Right.
Whereas Americans who buy things in American dollars,
yeah.
and so they could care less if the
Looks the
currency
same to
goes
me.
down. Looks the same to them, and so forth.
Now, you made an analogy, I think, once before that would be, if we did run into that scenario, it still might not be the end of the world, but it could put us towards, like you had brought up Japan, it could put us into that type of an economy growth situation.
We're definitely going to have a situation where the amount of government money that they need to continue to operate the government and the borrowing they do is going to continue to squeeze the productive forces of the free market.
Dampen growth.
It's going to dampen growth, and that's
Yeah,
what
long
happened.
term.
That's what's happened to Japan, and
Yeah.
and so we'll see. We'll see how it impacts it. But that's our biggest concern. But it's not something we're concerned about today, tomorrow, this year, even next year. It's probably many years down the road.
So Drew was talking to all the planners in the company this week, and he spurred off a comment that I was like, oh, that's a great thing for us to talk about for this month's coming video. Which his comment was pretty specific, but the topic overall is disability. Disability is most often thought of about when you're working years, but you can be disabled, and many people will become disabled at some point in their life, whether it's when they're young or when they're older. And I think that that's a great conversation for us to talk through. What are we thinking about as far as making a plan if we get disabled when we're young, and how does that change when you're older? So
when you're younger, the typical place you're going to look to is Social Security and your company group disability plan. So first off, you got to make sure your company has a group long-term disability plan. Bigger companies almost always do. Smaller companies like ours don't necessarily, even though ours absolutely has insisted on having one from the very beginning.
And if your company does have one, what's a good tax trick?
Make sure that you're always paying the premium with after-tax dollars. So if you pay group disability through your company with after-tax dollars, in other words, the premium they're paying is being taxed to you, then if you ever receive the benefits, it's after-tax monthly income. Whereas if you let the company pay the premium and it's not taxed to you, then if you ever receive the benefits, it's taxable income. Now, disability insurance is only 60% of your pay normally. I think you might see up to 70% in some unique situations, but normally it's 60.
And generally a dollar threshold too, right?
It can be. They're not going to insure the executive that's making $1 million. They're normally only going to give you up to maybe $10,000, $20,000 a month.
So if you're an executive making over $1 million, you may need a private policy.
You might need a private policy if you're concerned about that. But here's the point. If you're getting only 60% of your pay replaced and it's taxable, you're going to have a hard time living on that. If you get 60% of your pay and it's tax-free because you paid the premium with after-tax dollars, you could probably make ends meet on that after-tax benefit. So that's a key issue with disability. But here's another problem. With group disability, there are lots of little landmines there. It's not perfect in any way, shape, or form. If you really want perfect disability insurance, you got to get your own private policy.
Right.
But they're expensive, like all get at, and you have to get it before you become part of the group.
Yeah.
And or you get a supplemental group disability policy, but that's only if your income is high enough to get a supplemental. It's not an easy answer for that.
It isn't. It could be made a little bit easier if you are a member of a trade group or a professional association or a licensing group. Drew and I are CPAs, so we get access to additional life long-term disability through the AICPA. Doctors, architects, there's a number of groups that if you're thinking about getting this coverage and you're associated with some group, you might want to check with them to see if there's a group policy.
But you also have to look at them to make sure. A lot of times, if you get something from somewhere else, your group policy is going to say, well, we're not going to pay because you got something
Right.
from somebody else. A lot of them even say, if you get something from Social Security, we're going to stop paying and so forth. So you got to really think about how the disability is structured. But, if you want to talk more about that, just let your advisor know. We'd love to go into it and look at it in more detail. But let's get on to the next one. You're older, you become disabled. Now you got to have custodial care. Medicare, senior insurance, people who are over 65, does not cover custodial services. So if I'm disabled and I can't toilet myself, bathe myself, walk myself, or whatever, Medicare is not going to pay for that. You have to be impoverished. Medicaid
Right.
will pay for that. They ought to change the name so they're not so similar sounding, because most people think that Medicare will pay for this.
Now, that's an area where I think certain people in their older years need to be extra careful because they're starting to worry about running out of money. They're thinking, oh, gosh, I'm going to go on this Medicaid and get my nursing home bill paid by them. And some people inadvertently eliminate a portion of coverage for themselves.
That is true. Well, because a lot of times you see adult parents helping out children who are struggling as adults, and helping feed them money and so forth. And even though your assets may be going down or not growing at all or whatever, and you think you're doing a favor to your child to help them, you could actually be negating your ability to get government assistance even if you do run out of money. And to me, this is one of the greatest areas of concern, is when a parent is feeding money off to a child, or a child is using some other mean to take money from the parents. Both are negative scenarios that if that parent ever does need long-term care, we're going to be in a bind that we're going to need a really good lawyer to help us figure out how to get out of there.
Yeah, it's a 5-year look back. I know we're running short on time, but just to cover a couple other aspects of what you want to be thinking about disability when you become older, is the fact that there's certainly long-term care insurance. It's an option for some. If your health history isn't correct, it may not be an option. If the pricing isn't affordable, it may not be an option.
And you have to be under 60 years of age for the insurance.
The timing, yeah. Absolutely.
If you try to buy that after 60, it's either going to be too expensive, or some doctor wrote something in your medical report that they're going to say, no, thank you.
Now, I think something that we've always said, having a plan doesn't mean having insurance. Insurance can be a solution in a plan. One solution a number of clients have found, if they're able to be in the scenarios, they've selected an asset pool and said, hey, this asset pool, no matter what happens, I'm not taking from it, I'm not giving from it. This is my long-term care plan. This account that I have invested in such a way to be available for me and should provide X many years of care for me is the last asset I'll touch, and that's for long-term care. And that can be part of your plan.
That could be the plan. And then the other ones is go to a retirement community where they guarantee to take care of you no matter what level of care you need, even if you run out of money. There's life care communities, there are continuing care communities. And most people think when I say that, they have a vision of what that is. And it's usually a negative vision. And here's my point, is to our clients, if you're 70 years or younger and you had a negative thought about that, trust me, when we get to be that age that we're going to need that these communities know marketing. They know what's going to attract you to them, and it's going to be like the baby boomers go back to college, or it's going to be a combination of like a college campus and a Marriott resort campus, put together to attract the baby boomers to go to these types of communities. But you need a strategy, is the point. I don't care what your strategy is. You have to know what the strategy is. Even if it's I'm going to bury my head in the sand and ignore it, at least we know that that's your strategy, and everyone in the family knows that. Let's pray that they never need help.
Absolutely.
Anyway, we're out of time, Mikey. We got to go. This is Drew Tignanelli saying God bless.